Hello students, welcome to the series on entrepreneurship. Today we are going to study the financial and the non-financial institutions. Now let us first study the objective of this chapter. The basic objective is to study the concept of financial and non-financial institutions, the issues and the challenges, and the impact of these institutions on business and market. Now, let us study the various types of financial institutions. First, we are going to cover the financial and then the non-banking or the non-financial institutions. First is the commercial banks, the credit unions, the stock brokerage firms, the asset management firms, the insurance companies, the finance companies and the building societies. So, these are the various forms of organizations who are dealing with finances and are looking to the credit requirement of the society. We are going to study each institution and details and find out their role and functions. Let us first study the commercial bank institutions. A commercial bank can be defined as a type of financial institution which provides a wide range of services such as mortgage lending, giving business and auto loans and accepting deposits. So, what are banking institutions? They are simple financial institutions which basically form the pulse of the economy, that is without them most of the economy would not able to function in a defined way. They streamline the economic activities of deposits and savings and give credit to the customers. They offer loans. They source out funds from the government or from other big investors and try to manage the circulation of money in such a way that where there is a gap, the funds are pumped in. The functions of the commercial banks. It deals with investment products such as savings accounts and certificates of deposits. They give facilities of safe deposit boxes, bank tellers, ATMs and wallets. So, banking is basically a function which is dealing with the daily life needs of the people, as in when they need money they can go to the bank or they can vend out from a machine, that is the ATMs have become a big way to get your funds as and when needed. So, it is the safety and you can earn the interest rate also. So, the banks are able to give you a kind of assurance that whatever you have deposited is safely handed and is earning, that is your wealth is not going to be depreciated and somewhere it is going to give you some rate of interest. Now, let us study credit union institutions. This is a member owned and not for profit financial cooperative. The profits are shared amongst the members as they pool their money in bank to provide loan money to each other. The services offered by the credit unions are online banking, share accounts and credit cards. Now, these credit unions basically are member owned institutions where rich members come together, they pool up their funds, that is they are not working for profits, but they are looking into the needs of the people as in when somebody is requiring money and if other person has surplus fund, that fund can be pumped into the other person's institution. So, in this way they can also cover their risk activities also, that is as in when they need funds they can use somebody else funds. So, the basic function is to do as simple functions as like a bank, that is they have transactions, they share their accounts and they can use their credit cards, but it is not for profit. Generally it is to look into the needs of the customers or the members who are associated with this union. Now, is the stock brokerage firm institutions. They are responsible for facilitating of buying and selling of financial securities between a buyer and a seller. A brokerage firm serves a clientele of investors and employs a number of stockholders through whom they trade public stocks and other securities. They get commission for their services. So, stock brokerage firms, they are financial institutions who have clients and for them they are buying and selling shares. They have basically lot of money in surplus because the client's money is used into securities and equities according to the objectives of the client's mindset. Then is the asset management firm institutions. They provide investors with more investment options. They have much bigger pool of resources. The company will invest the pool of funds of its client into securities that match the declared financial objectives. Asset management companies manage hedge funds, mutual funds and pension funds. They charge service fees or commissions. So, asset management companies, they are professionally owned companies who have experts and they use a large pool of money into good securities which can meet the financial objectives of the investors. Here the knowledge and expertise of the professionals is higher than the client, and the client basically has little amount, but when it is pooled up with others money, it gets them a larger resource, and this resource can be used to earn profits. So, they try to hedge the funds and earn through securities to manage the financial wealth of the people. Then is the insurance company institutions. The insurance company gives protection of financial loss resulted from damage to insurer or his property. The policies relate to health insurance, life insurance, home insurance and vehicle insurance. So, the insurance company is basically a company which covers the risk of the clients. So, it is a risk management company where basically the profits are not mandatory, but in times of losses or in bad times you get secured amount which assures your basic security that in times of losses you will not be on roads, but you will get some amount of money to manage or streamline your business processes. So, according to the different options and the policies, people pay premium and get their risk covered. Services offered include the insurance services, the securities, the buying and selling services of the real estates, the mortgages, the loans, the credit cards and check writing. Now, insurance company is also a very big financial institution because they have large resources or a large amount of money uh, which is collected from the premium of the people. Now, this money is used for development, that is they give wealth to the country in terms to streamline the functions of the investors. They invest in securities, they give loans to the other institution, they earn profits on these loans, and in times of need they look to their clients also. So, insurance companies, they are big financial institutions which, like banking institutions, are involved many activities of buying and selling of mortgage, giving loans, buying into properties and many other functions they are dealing. Now, the finance company institution. A finance company is defined as an organization that provides loans to businesses as well as consumers. It is similar to bank and acts as a lending activity by extending credit. It does not accept deposits from people. It gets funds from banks and other resources. Now, finance companies work as banking institution, but they are not accepting the deposits of the people. They are only lending institutions, and they get their resources from big investors or they tie up with big venture capitalists and get the funds. They utilize the money at higher rate of interest to earn profits for the institutions. Now, let us study the concept of building societies institutions. A building society is defined as a financial institution that gives banking and other financial services to its members. The building societies are owned by the members of mutual organization. Services offered by building societies include mortgage and demand deposit accounts. They are supported by insurance firms. Now, society is a kind of organization which is formed under law, and it is a member owned organization which looks into the financial needs of the people. Here it works under the concept that the funds are gathered and used as and when needed by the customers and earn profit. Role of financial institution. The various financial institutions generally act as intermediaries between capital market and debt market. The financial institutions, they are also responsible for transferring funds from investors to the companies. They regulate and control the flow of money in the economy. So, financial institutions are important for any society and economy. They fill the gap between the investors and the company, because company needs operational and working capital and investors have surplus money. They do not have time to do business. So, they can connect with people who are already into business and who have made up structure. Their money can earn profits and make them wealthy. They they are a link between capital market, that is you have money market as made up, and they link the debt market, that is companies can buy debt from market, because debt is always a cheaper instrument to do business, because the rate of interest is very nominal and the kind of profits generated in the business is high. So, we can match up the needs of the investors and the companies and design a fabric where the flow of the money is decided and systemized in such a way that it earns greater profits for all the people in the network. Now, let us study the services offered by various financial institutions. The services offered by commercial banks, they are the insurance services, the mortgage, the loan and the credit card. So, the various financial institutions offer you loans, give you interest, give you debt, and they also cover your risk, that is they are looking into the insurance needs of the people. The insurance can be related to your life or to non-life needs, that is general insurance of vehicles or business equipments. Now, let us study the non-banking financial institutions. They do not have a full banking license. They are not supervised by national or international banking regulatory agency. The non-banking financial institutions facilitate bank-related financial services such as investment risk, pooling of contractual savings and market brokering. So, non-banking financial institutions work as banking institutions, but they are not regulated by any banking regulatory authority. That is, they manage their own funds and they look into the needs of the people on private basis. They have the same functions as the banking institutions, but they are not supervised by any government institution. Now, the services offered by the NBFCs is the non-banking financial companies offer most sorts of banking services such as loan and credit facilities, private education funding, retirement planning, trading in money market, underwriting stocks and shares. So, they are looking into the financial needs of the people, that as and when you need loans for your home loans or for your education or for even car loans or auto loans, they give you everything related to your life and they do a kind of a pooling of funds to look into your needs of retirement and also use your funds to trade into securities. So, they work in a dedicated and a coordinated way to look into the economic needs of the people. Now, growth and stability. There is a high correlation between financial development and economic growth. The non-bank financial institutions can protect economies from financial shocks and enable speedy recovery when these shocks happen. Now, if the non-banking financial institutions of any economy are strong, they can support the country and the economy by absorbing the shocks or the shortages of funds when the government is in crisis. The financial health of the people is regulated if the institutions are strong. That is, if the venture capitalist and the banking institution have wealth, they can look into the needs of the businesses when there is emergency. So, higher is the credibility and role of non-banking financial, higher is the maturity of the economy in terms of economic growth. Now, let us study the problems of non-banking financial institutions. The NBIFs operate without a banking license. In some countries, their activities are largely unsupervised, both by government regulators and credit reporting agencies. Thus, a large NBFI market share of total financial assets can easily destabilize the entire financial system. Though the non-banking financial institutions offer lot of advantage and growth to the economy, But if there is corruption, and if the non-banking financial institutions don't have a credit rating in the market, they can destabilize the economy, because the funds of even the innocent investors that's tied up in the institutions, because it is a circulation of money. And since there is no regulating authority or no credit rating agency which can control these institutions, so sometimes if these banking institutions are corrupted and they get into losses, they will hamper the growth of the economy, and there will be a shock, or they can even destabilize the economy. Now, risk pooling institutions. Insurance companies underwrite economic risk associated with illness, death, damage, and other risk of loss. In return to collecting an insurance premium, insurance companies provide a contingent promise of economic protection in case of loss. So, the non banking financial institutions play an important role in managing the risk also. They are not giving you the interest rate, or they are not giving you the profits, but still they are covering the risk. Now, in times of emergencies or in times of contingencies, when people are of shortage of funds, the insurance companies do manage the risk at a cost which is very low. That is, the investors or the sponsors or the buyers or the clients do have to buy the policies for a premium of money. That is, you have to pay certain amount of money in order to get that security. The risk can be covered because large pool of many clients is being gathered, and if one client is in risk, the other people can support them. Now, let us study the types of insurance companies. We have the general insurance and the life insurance companies. The general insurance tends to be short term, and the life insurance is a long term contract which terminates at the death of the insured. So, general insurance basically relates to your equipment, to your car, and to your vehicles. That is the auto insurance, which is an important part, as the vehicles are costly, and if they meet with an accident, it will be a liability on the client. So, at a certain amount of payment of premium, you can secure your vehicle. But life insurance is a long term contract, that is, you have to pay the premium and you have to be with the company till your death. So, the institutional contract is very easy, and they can use the funds of the people for a longer time of time. Now, contractual saving institutions. The contractual saving institutions, also called institutional investors, give individuals the opportunity to invest in collective investment vehicles as a fiduciary rather than the principal role. Collective investment vehicles pool resources from individuals and firms into various financial instruments, including equity, debt, and derivatives. So, here you can invest as a fiduciary, that is, you can pool up your funds and can invest in equities and shares through mutual funds or through other derivatives to earn profits. Now, let us study market makers. Market makers are broker dealer institutions that quote a buy and sell price and facilitate transactions for financial assets. Such assets include equities, government and corporate debt, derivatives, and foreign currencies. After receiving an order, the market maker immediately sells from its inventory or makes a purchase to offset the loss in inventory. Market makers are basically institutions who are dealing with the buying and the selling of the securities or various financial products. Financial products also include the currencies and the other derivatives available in market. On a call, uh, they decide a rate, that is, you have a buy and a call rate. When you buy it at a certain rate, and if you get a call at a higher rate, is you can sell it. So, this is the kind of a business in which these markets makers basically impact the profits through the buying and the selling of the financial products. The differential between the buying and selling quotes or a bid offer spread is how the market maker makes a profit. A major contribution of the market makers is improving the liquidity of the financial assets in the market. So, if there is difference in the rates of the buy and call, you can earn profits. This manages the liquidity in the market because the funds are transacted at an easy rate and at easy call. Higher is the business, higher is the liquidity in the market. Now, let us study the specialized sectorial financiers. They provide a limited range of financial services such as a targeted sector. For example, the real estate financiers, the channel capital to prospective homeowners and leasing companies. We have specialized sector wise financiers who are looking into the property or who are also looking into the leasing facilities. So, these are the big institutions or big people investors who have funds who are only investing either in the real estate or who are only investing into buying or leasing their properties. Now, let us study the financial service providers. The financial service providers are the both brokers of securities and the mortgage, management consultants, financial advisors. Their services basically include in improving informational efficiency for investors. They are offering a transactional service by which an investor can liquidate existing assets. So, the financial services basically are the brokers or they are the consultants or they are financial advisors who advise their clients to manage their funds. The transaction of the funds or the financial products can give money to the market. They also get the commissions for their advice. Now, let us study the summary of this lecture. The financial and non-banking institutions are important for the economy to generate revenues. The financial connectivity can improve options and opportunities for doing good businesses. The power of entrepreneurs can be increased as they can access to financial resources through these institutions. Now, the financial institutions, they are important for entrepreneurs because to manage funds is a big issue. When you have surplus funds, they need to be assured with banking institution to earn rate of interest, and when there is lack of funds, you need to take loan from the companies because using your own funds can liquidate your wealth. So, it is always easy to use debt instruments in business rather than using your own asset valuation, because that basically gives you credibility in the market. So, the kind of the management of funds for entrepreneurs can be done by good banking and non-banking financial institutions. I hope the students must have understood the concept and the importance of the financial and banking institutions. Thank you.